Warren Buffett is known today as the world's best investor, having generated 20% annual returns in his company, Berkshire Hathaway, since 1965. No one else comes close to that record. The more you study him, the more you realize just how difficult his path is to copy. But how did the Oracle of Omaha actually do it? What were the specific decisions, strategies, and investments that turned $1,000 into more than $160 billion? Buffett's money-making journey began unusually early in life. Born in 1930 in Omaha, Nebraska, young Warren developed an early appetite for commercial trade. One of his early inspirations was a library book he discovered at age 7. Soon, little Warren was selling chewing gum and Coca-Cola door to door. At age 11, Buffett took his first step into the stock market. He had saved up $114.75 from various odd jobs. With that money, he bought 3 shares of City Service preferred stock at $38 per share. Almost immediately, he experienced severe market volatility. The price dropped to about $27, testing the young investor's nerves. But he held on until it rebounded to $40, where he sold for a small profit. No sooner had he sold the shares than City's service stock shot up to over $200. This taught Buffett a brutal lesson about the cost of impatience. In his own words, he had become a capitalist, and it felt genuinely good. His entrepreneurial ventures continued through high school. He bought a used pinball machine with a friend for $25 and installed it in a local barbershop. As quarters rolled in, they expanded the operation. At age 16, Buffett and his partners sold that pinball business for $1,200. His cut from those profits helped him clear the $1,000 milestone. By age 15, thanks to multiple paper routes in Washington, D.C., where his family had moved, Buffett had saved about $2,000. That amount equals over $35,000 today. At 14, he took $1,200 of his savings and bought 40 acres of Nebraska farmland. He partnered with a local farmer who worked the land, taking a portion of the harvest profits. By the time he finished college, Buffett had amassed nearly $10,000. His first $1,000 came from pure hustle and an ability to spot local commercial opportunities. But by his early 20s, he needed a scalable method. In 1950, he read Ben Graham's book, The Intelligent Investor. The philosophy inside transformed his entire approach to financial markets. Graham practiced a style later described as cigar butt investing. This meant buying shares in beaten-down businesses that were so cheap they offered one last profitable puff. After earning his master's degree under Graham, Buffett worked at his mentor's investment firm, gaining hands-on experience in deep value pricing. He returned to Omaha in 1956 at age 25 and launched his own investment partnership with roughly $105,000 from family and friends. Buffett put in only $100 of his own cash. His fee structure charged 0 management fees and took a percentage only after a 6% hurdle rate. With his partner's capital, Buffett hunted for bargains in the market's clearance bin. The partnership achieved a compounded annual return of nearly 26%. One of his early legendary plays involved the Sanborn Map Company. Sanborn made maps for insurers but held a massive portfolio of marketable securities. Buffett realized Sanborn stock traded at $45 per share, while the cash and securities in its vault were worth $65 per share. Wall Street priced Sanborn like a dying mapmaker while ignoring the hidden fortune in its treasury. Buffett bought up 43% of the company. He joined the board and pushed management to repurchase stock at $65 per share, extracting the underlying value for his investors. The result was a 44% gain for his partnership. His biggest win of the 1960s, however, came from a different kind of crisis. In 1964, American Express was struck by a massive scandal involving fraudulent soybean oil collateral. Panic selling crashed the stock price. Buffett looked past the panic. He noticed that ordinary people were still swiping their Amex green cards at local restaurants and shops every single day. The core brand and consumer trust remained fully intact. Buffett invested 40% of his partnership's capital into American Express stock. Within a few years, the stock multiplied, generating massive profits. By 1962, the partnership assets exceeded $7 million. Warren's personal share crossed $1 million. At 32 years old, he had turned his initial capital into a seven-figure personal fortune. Around this time, he bought shares in a failing New England textile manufacturer named Berkshire Hathaway as a standard value play. After a dispute with the company's CEO over a share buyback promise, Buffett turned aggressive, bought control of the firm, and fired the CEO in anger. He admitted this was an emotional reaction. He now found himself running a dying textile business with shrinking margins and heavy overhead costs. By the late 1960s, Buffett faced an unusual problem. He had too much money to manage and too few cheap cigar butt stocks left in the market. In 1969, feeling the market was dangerously overvalued, he closed his partnership and returned capital to his investors, stepping back to focus on Berkshire. This moment marked a fundamental shift. Charlie Munger entered the picture as Buffett's permanent intellectual partner and strategic sounding board. Charlie delivered a clear message. Stop buying mediocre companies just because they are cheap. It is far better to buy a wonderful company at a fair price. This philosophy change became the single biggest turning point in Buffett's career. He needed to diversify Berkshire away from dying textiles. In 1972, an opportunity arrived in the form of See's Candies, a famous West Coast chocolate maker with fierce customer loyalty. See's possessed true pricing power, the ability to raise prices every single year without losing customers. But the asking price was $30 million. That valuation was far higher than any asset-based bargain Buffett was used to paying. He hesitated, arguing the price was too steep for a regional candy maker. Charlie Munger argued that the brand moat was worth every penny. Buffett negotiated hard, refusing to go above $25 million. The seller finally caved. Over the following decades, See's Candies delivered over $2 billion in pre-tax profits back to Berkshire Hathaway. That single acquisition proved that an extraordinary business brand is worth far more than its tangible machinery and inventory assets. Armed with this realization, Buffett scanned the market for other dominant franchises suffering from temporary market downturns. In 1973, during a severe market drop, he invested $10 million into the Washington Post Company when its stock was battered by general panic. That $10 million stake grew to be worth over $1 billion by the 1990s. Brand strength consistently outperformed short-term market noise. In 1976, GEICO Insurance hit financial trouble and neared insolvency. Buffett knew the insurance business model inside out and understood its low-cost advantage. He poured capital into recapitalizing GEICO, eventually taking full ownership. It became an enduring cornerstone of Berkshire's financial empire. By the late 1980s, Berkshire Hathaway operated as a compounding machine, channeling insurance float into high-return equities. In 1988, Buffett made his largest stock investment ever up to that point, purchasing shares in the Coca-Cola Company. Coca-Cola had stumbled following the 1987 stock market crash, but its global distribution and consumer addiction remained completely unshaken. Buffett spent over $1 billion to acquire a 6.2% stake, making Coke Berkshire's single largest portfolio holding. Many analysts question the massive concentration, but Buffett understood the global brand moat and knew the company would keep raising dividends worldwide. Within a few years, the investment tripled in value. Today, that initial $1 billion stake is worth over $25 billion. Even more remarkable, Coke pays Berkshire roughly $700 million in annual dividends, returning most of the original purchase price every year. In 1986, at age 56, Warren Buffett officially became a billionaire on paper as Berkshire stock reached new heights. His transformation from a scrappy microcap stock picker into the head of a multi-billion-dollar conglomerate was fully complete. Reaching $1 billion might look like a finish line to most people, but for Buffett, it served as a base for even larger capital deployment. Berkshire had grown so large that small investments no longer moved the needle. Buffett needed corporate elephants to sustain growth. During the dot-com bubble of the late 1990s, tech stocks soared while Buffett sat quietly on the sidelines, refusing to buy businesses he did not understand. When the tech bubble burst, Berkshire emerged completely unscathed, while critics who called him outdated watched their portfolios collapse. When the global financial crisis struck in 2008, Buffett stepped in as a lender of last resort to major blue-chip institutions. He injected billions into Goldman Sachs and General Electric, securing high-interest preferred shares and lucrative stock warrants in return. These crisis deals generated massive profits while cementing his reputation as a trusted financial anchor during times of systemic panic. Yet the most surprising chapter of his later years involved technology, a sector he had avoided for nearly half a century. Around 2016, his investment deputies began acquiring shares in Apple. Buffett soon realized Apple was not just a hardware maker. Apple operated as a consumer products ecosystem with immense customer loyalty, recurring service revenue, and enormous pricing power. By 2018, Berkshire owned 5% of Apple, investing roughly $30 billion into the tech giant. Apple's stock surged through the late 2000s and 2000s, growing to occupy half of Berkshire's equity portfolio with a peak value near $160 billion. That single tech bet added tens of billions to Berkshire's balance sheet, proving that sound fundamental principles apply anywhere if evaluated correctly. In early 2021, Buffett crossed another historic threshold as his personal net worth surpassed $100 billion. Today, his fortune stands at $165 billion, achieved without founding a tech startup, taking massive salaries, or inheriting wealth. His billions are the pure product of investing acumen, emotional discipline, and a capital snowball rolling for nearly 8 decades. But the story does not end at $100 billion. The modern era of Berkshire Hathaway presents entirely unique structural challenges for capital allocation. Managing a pool of capital exceeding $300 billion means that traditional stock picking no longer moves the needle for overall performance. This reality forces Buffett and his successor, Greg Abel, to hold unprecedented cash reserves, waiting patiently for massive market dislocations. Critics often misinterpret these massive cash piles as a lack of confidence in the American economy, missing the true strategic purpose. Cash acts as an optionality weapon, giving Berkshire the absolute freedom to act instantly when every other financial institution faces severe liquidity dry-ups. Look closely at how Buffett structures his life, even while commanding a fortune larger than the GDP of many sovereign nations. He still lives in the same modest stucco house in Omaha that he purchased in 1958 for $31,500. He drives himself to work, eats breakfast at McDonald's, and spends hours every single day reading corporate annual reports and financial statements. This absolute lack of lifestyle inflation protects his cognitive bandwidth from the distractions that destroy the focus of most wealthy executives. Wealth psychology teaches us that money is ultimately a tool for gaining autonomy over your time, not an instrument for buying superficial status symbols. Buffett often notes that the most important quality for an investor is not intellectual brilliance, but temperament and emotional self-control. Most people fail in the markets not because they lack analytical intelligence, but because panic and greed hijack their decision-making during corrections. When market panics arrive, human biology pushes us towards survival mode, making long-term rational planning nearly impossible for untrained minds. Buffett trains his mind to treat market fluctuations as friendly business partners rather than emotional threats designed to terrify him into selling. This mental framework allows him to remain completely objective when stock prices drop by 50% across wonderful underlying operating companies. Another vital pillar of his longevity is the power of compounding operating across decades rather than quick speculative months or quarters. Most investors destroy their long-term returns by constantly jumping between trendy asset classes, trying to time short-term market cycles. Buffett realized early on that interrupting compounding through unnecessary portfolio turnover and heavy tax events acts as an anchor on growth. Once you find an exceptional business with an unbreakable economic moat, your primary job is simply to get out of the way and let it work. Consider how the definition of risk changes as your personal wealth and financial literacy expand over the course of your working life. To an amateur, risk means stock price volatility on a daily computer screen, causing intense emotional discomfort and knee-jerk reactions. To a professional like Buffett, true risk means the permanent loss of capital or a fundamental deterioration of a company's competitive advantage. By shifting your focus from daily price swings to underlying business performance, you eliminate 90% of the psychological stress of investing. This mindset shift separates the permanent wealth builders from the endless cycle of retail traders chasing short-term speculative trends. As we look at the legacy of the Oracle of Omaha, we see a blueprint built entirely on patience, intellectual honesty, and emotional discipline. You do not need to discover the next high-tech unicorn or time every market top and bottom to achieve true financial independence. You simply need to apply sensible principles, master your own behavioral impulses, and protect your capital through every economic season. The snowball effect requires a long hill, wet snow, and most importantly, the discipline to let it roll without interfering out of impatience. Every financial decision you make today either feeds that snowball or melts it away through needless friction fees and emotional errors. Take control of your financial psychology, master the mechanics of business valuation, and give your capital the time it needs to compound. The journey from $1,000 to billions is not reserved for the lucky few. It is accessible to anyone willing to think long-term. If you want to understand the exact valuation methods and moats behind these strategies, check out our step-by-step stock analysis course linked below. It is the complete masterclass designed to take your investing knowledge from absolute beginner level to professional confidence. Enrolling in the full program is also the best possible way to support the independent research and deep dive production work we do on this channel. We also offer a completely free introductory short course if you want to test the waters before making a commitment to the extended curriculum. Whichever path you choose, remember that financial freedom is built one disciplined decision at a time over many years of consistent effort. Thank you for watching this deep dive into the financial mind of history's greatest investor. Make sure to leave a like if you found value here. Subscribe to the channel for more breakdowns on wealth psychology. And I will see you all in the next comprehensive video analysis.